Let's bring in some smart people who do this stuff for a living. We'll kind of see if we can break it down a little bit. Chris Whalen, founder of Whalen Global Advisors, joins us here, and Hugh Hendry of Eclectica Asset Management. They joined for an extended roundtable on what we might be seeing in these markets. Hugh, thanks so much for joining us here in our studio here. What do you make of the past few days? The Fed, the ECB, we've got some banks. Kind of, I don't know if it's crisis or not. That's debatable, but there's a lot going on out there. What do you make of it?
I don't think it's debatable.
Okay.
You know, this is Wild Coyote, and we went over
the clip.
But I mean, seriously, this is real, right? I think the Fed will stand charged with the greatest Fed folly in a very long time.
In terms of raising rates too fast, or what? Or too late?
So it is a fact that they raise rates fast, yeah, in terms of the timeline and the magnitude. And typically, the Fed doesn't do that. And there's a reason for that, because, you know, a bank is effectively like a hedge fund, yeah? It has... It gets the money from deposits, right? But there's no gate. Yeah, you can take, like with a hedge fund, they insist. I mean, if you're in like one of those big hedge funds, try getting your money out. It takes you it takes you 2 years. With the iPhone, with the banks, so the gate issue, right? But the other issue is that the assets are loans, and it takes kind of like 2 years to reprice your loan book so that you can raise your CDs without destroying your net interest margin, like without going into losses. So the Fed is cognizant of that, right? And it takes its time. This was an impatient Fed, okay? And then what we've discovered...
Well, first too patient, right? And then impatient.
Well, I think the world of economics has changed profoundly, but we may come back to that. But yeah, and then impatient. But it's the deposit flight revealed. There's always a revelation in markets, and the revelation has been the conceit and the arrogance of a hold-to-maturity bond portfolio. And that was fine, okay, when rates were stable, but when you aggressively hiked them, and then with this technology jump with the iPhone and with the deposit flight, suddenly you had to mark, because deposits were fleeing, you had to reduce the HTM portfolio, and suddenly you discover that you've wiped out your shareholder funds. I mean, there was a Fed report going back, I think, to the 23rd of March, which revealed, as we know, that total bank assets in the US, $23 trillion. What is that? Give us a reference. That's 1 times GDP. Yeah, and you had about 23 billion of shareholder funds, right? In fractional reserves. I mean, we were kind of leveraged entities, but the mark-to-market or the unmarked loss was $2.3 trillion. Okay, right. So we're talking about, you know, metaphorically, the kind of notion of the dead people walking, the banking sector, and that's kind of. I'm afraid that's on the Federal Reserve. We are staring at a scenario which is very similar to 1930, where we had the widespread failure of the U.S. banking community.
Chris Whalen, what do you think about that? I want to bring you in here because you're one of the foremost bank analysts in the country. What do you think about Hugh's point that the Fed really kind of has blood on its hands?
Oh, I think I totally agree with Hugh, and the 1930 metaphor is the correct one, because you know, this isn't 2008, which was basically just a bit of a tantrum around private mortgages. This is solvency. This is a Fed-induced, panic that looks a lot like the 80s, by the way, with Paul Volcker. The last time we had benchmarks 4 or 5 points above bank deposit rates was back in the 80s. And we destroyed the S&Ls, but the S&Ls didn't matter. These banks matter. That's the difference. And I think that the Fed is badly they panicked in 2018 with the money market crisis in December. They started dumping reserves into the system the next year, a year before COVID. You can see it on the Bloomberg. Look at the index for Ginnie Mae duration. Wonderful chart you guys have on the terminal. It tells the story. So by the time we get to COVID, the duration on $2.2 trillion in Ginnie Mae securities is 1, which is almost impossible.
But Chris, I mean, we've heard from some analysts that most or a lot of these, or I would say most of these banks, they have enough capital and
Let's
assets.
talk specifically about PacWest. We
PacWest.
just had our regional banks analyst in here, Herman Chan. He said they have 188% assets to deposits.
I know, but it doesn't matter. These are going concerns. When the stock price gets to 0.3 times book, that tells you that the bank's going out of business. It's like the politicians. They get voted on every day in the stock market, right? We're voting on PacWest this morning.
Hugh, explain it to me like I'm 5, okay? if every depositor goes into PacWest and says, I want my money out, they can have it out. As far as I understand it right now.
No, but you're thinking of this like it's a wonderful life. No, that's not the way financial markets work. They want to know that that bank is a going concern. And when the stock price gets this low, the business counterparties back away. And the formula in the Bloomberg, by the way, that generates probability of default is geared off of the equity price. Okay. What do you think the hedge funds use? That's how it works. So
I'm typing it in right now. PacW equity DRSK.
And what is it, like 400 basis points? So my point is, there's a lot of banks behind this one. And, I own Western Alliance. I love that bank. At 0.7 times book, I think they'll be fine. They had already traded off because the mortgage market had come off. That was one of the best performing banks in the country in 2021. So, what's happened is the Fed wants to pretend that they can have a traditional anti-inflation scenario, just raising target rates, but they're ignoring the manipulation of the bond market that came with quantitative easing.
Let me get Hugh in here because
$9 trillion worth of securities.
Hugh, you made your money and your name by figuring out how this kind of thing is going to play out, right? How does this look to you right now? I mean, we've had a few days of this 60%, 50%, 40% drops in these bank prices, and yet the Fed came out yesterday and said, the U.S. banking system is sound and resilient.
Yeah, I'm liar pants on fire. So I'm now really representing asset capitalism. The eclectica is no more. This is the world of asset capitalism. There are occasional ripples through risk assets. When people kind of get excited with this notion that the Treasury might come in and insure all deposits. I want to tell you that we are past the point of relevancy for that procedure. My fear, and I do not say this lightly, I've given it great consideration, given the present peril with regard to the magnitude of losses on security portfolios held within predominantly the regional banks, okay, you have to cast your mind back to 1934 and the Gold Reserve Act. Back then, as everyone knows, US citizens and their gold was confiscated. I can actually conceive of a federal or a treasury rule coming in and saying, for the next 180 days, you can't pull your money out of the banking sector.
That would be terrifying.
That would be terrifying. But let me tell you, the issue, people are, the deposit flight today is not people feeding uninsured deposits. It's people saying, I'm getting paid 10 basis points on a CD. I need 500. And what was catastrophic about yesterday was the Fed hiked again. It went, hey, why don't we just encourage more deposit flight? They are do-gooders, but they're incompetent and they're not seeing the picture. We are on the verge of a catastrophe which will rival 2008.
They keep trying to separate. Every Fed speaker we've heard the last couple of weeks says they want to separate monetary policy on the one side with financial stability on the other, and they don't want to mix the two, right? And the Fed funds rate is a monetary policy tool. Chris, what do you think? Because I've asked a lot of people, who do you blame for the collapse of SVB? Who do you blame for the collapse of Signature and now First Republic? Is it possibly the Fed raising rates 500 basis points in a year? And to a man, until today, everyone has said no.
Well, look, these banks did stupid things. I've written about this, Silicon Valley particularly. But the key thing is that the Fed is in a very pedantic sort of way, and I love what your guest has been saying, by the way, I totally agree. But they want to continue to think they can separate monetary policy from financial policy. When we execute monetary policy in the bond market, for Christ's sake, it's not credible for the chairman of the Fed to get up and tell us yesterday that the banking system is fine, when the FDIC has already published numbers that show that it's insolvent. Okay? The two agencies need to talk to one another. And I've spoken to governors about this in the past. I worked at the Fed in New York. They don't talk to the bank supervision people. And when they were on the Hill, you saw Vice Chairman Barr. He was asked, did you talk to the bank supervisory staff about your monetary policy, about quantitative easing? And the answer was no. So I think we should make economists wear ankle bracelets. I really do. These are the most dangerous people in our society right now.
Hey,
and they
Hugh,
are going to crash the system. It is very, very close to 1933, my friend.
Hugh, we had, it seems like a lot of folks are saying, we had JP Morgan come in and buy First Republic. But Jamie Dimon, he can't be literally JP Morgan and go out and support the system. Do you have a solution? Do you feel like our regulators need to do something now? And if so, what would that be?
Yeah, it's called ZERP. It's called, we got to be humble and we got to say, we kind of got this wrong. My point, hey, listen, we've got debt, which is approximately 4 times the economy, okay? We've got interest rates which are 5%, okay? If we make the comparison with Jay's idol, Mr. Volcker in the 70s, we had 20% interest rates and we had debt which was 1 times GDP. We've gone back to the future. Effectively, we are at the point where the Fed was at 20% interest rates and it was breaking everything in 1982. Okay?
So in 1982, we had 20% rates, and what was debt to
1
GDP?
times. So 1 times 20 is 20.
Right, and now we're at
4 times debt, and we're 5.25, right? So we've actually surpassed, right, where we've all go. So Jay, you did it, okay? Now get your ass and get those rates down to 0, or the thing's gonna blow up.
But where do you get 400 times
zero.
400% GDP? Where do you?
Okay, well, we're like 3.67 or something, right? And I'm running up to the neatest decimal point. But if you add government debt, household debt, financial debt, industrial debt, you get.
Just real quickly, guys, coming across a Bloomberg terminal, another red headline: Western Alliance mulls options, including a potential sale. So here we go.
Yeah.
That's a Financial Times. I'm going to credit the Financial Times.
I think if we have another major bank failure, Jay Powell's going to have to resign. And this system cannot tolerate that kind of, coming to Jesus, if you will, on the part of an agency like the Fed, because we depend on them to get it right. And when they don't get it right, to the earlier comment, what should they have done? They should have gotten Fed funds up to 3.5 or 4 and sold assets. That was the astute thing to do, given their past policy moves. But instead, they're pretending it's 20 years ago, and they can just raise, target rates as fast as they want to reclaim their credibility, because that's what's really driving this. The panic of Powell, and then you had the fact that they were caught out on inflation, and they were so embarrassed as an agency that now they've tried to regain their credibility in 18 months?
Right. I want to reset this just so listeners understand. We're talking to Hugh Hendry, who was the founder of Eclectica. Now he's a surfer and a hotelier.
I tweet. I'm the acid capitalist on Twitter.
And he's a Twitterer. And then we're talking to Chris Whalen. I'm going to say, for me at least, one of the foremost banking analysts in the country. And of course, he's also the chairman of Whalen Global Advisors. We had yesterday PacWest saying they're going to look at strategic options, including the possibility of a sale. Their shares now are down more than 50%. Western Alliance now is saying it's mulling options, including a potential sale, and their shares are down about 30%
and trading is halted there for Western Alliance.
I'm getting goosebumps to some extent because this is so scary and so dramatic, but I don't know if I'm just not smart enough to push back against these two geniuses here. We have a listener writing in and asks, of Hugh, do you think any of this is imminent? And then he's got a list of 3 things: government intervention, deposit guarantees, or a ban on short selling.
Oh heavens! Bans on short selling. Let's ban the truth. Let's pretend.
I think his concern is: are we in a real crisis here that's about to snowball?
This is Wild Coyote. We've gone over the cliff. What happened yesterday? The FOMC. It's no longer relevant, right? Policy's too tight. Policy will be collapsed. Like I say, my one fear, if you're talking about government regulation, government intervention, I don't say it lightly, but I fear that they may have to gate the deposit base of the U.S. within the banking sector.
I agree.
That's
And Hugh,
Chris.
here's
Do you
the
really
question.
think that regulators are going to put up gates? I mean, that would cause the biggest bank run since the 1930s, I imagine.
But that's what happens when the central bank injects volatility into this system. That's what they have done. To Hugh's earlier point, right? You can't move interest rates this much when the average coupon in the mortgage space is 3%. Everyone is insolvent. Just do the math, right? But unfortunately, these PhDs at the Fed can't do math. It's astounding.
So, but
to me.
I guess again, I'm not, you guys are the experts, but their focus, or one of their key focuses, is to fight inflation. So the only tool they have, or one of the main tools they have, is raising interest rates. Do you suggest that they should have stopped at 3% or something like that, or they just go too fast?
I want to let me take that one. Let me take one because what we are seeing here is we are seeing the crucifixion of the common man on the cross of the vanity of Jay Powell. In 2020, Jay Powell went on U.S. prime television, daytime television, and he said, "Folks, we got this. We at the Federal Reserve, we're printing money."
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally.
I was like, Jay, they'll send you to prison. You're not allowed. You have no federal sanction to print money. What are you doing? But again, the Fed's is in the business of camouflage deceit. It's in the business of aura. We are all powerful. And so it made that comment. And then you get this profound supply shock, which was COVID, right? And prices get elevated. And people go, hey, Jay, you're printing money, and now prices are like running double digit. And Jay went into meltdown in terms of the institution, and the rapidity of the rate hikes was to protect and safeguard and pull back that comment that they had printed money. Inflation, I believe, is transitory. And now, with bad deflationary money running through the banking sector, I would anticipate that we're going to see prices. Hey, listen, 90 days. CPI is going to be running at 3.5%. By the end of the year, I think we're going to be close to zero again. We're going to be below the Fed's target.
Chris, this is terrifying. What do you think?
Well, no, but to his point, if you're a banker right now and you're trying to survive, what have you done? You told your loan officers to step back and turn it down. So you know this economy is going to slow down because the supply of credit from the banking system, from the bond market is going to be greatly reduced because everybody who's got this problem we've been talking about with interest rates has got to raise cash. Everything is for sale. So Jay Powell has basically put the whole banking industry, and I mean big and small banks, don't think the big guys are immune here. They're all for sale now. They're all in liquidation mode. And I think the Fed is going to come out of this greatly weakened. I think you're going to see Powell forced to resign. And then I think Yellen will be following him out the door. Because,
But Chris, do you believe that regulators could
the debt ceiling this week, right?
Yeah. Well, now we have a tsunami before the tsunami. Do you believe that that regulators could put up gates to deposits?
Yes, it's inevitable. It's very third world, but here we are. We've got to start practicing our Portuguese. I really think, I worked in the emerging markets years ago, and it is scary to me watching this because it's like deja vu. And it's not just Wile E. Coyote. I think that's very clear, but it is the hubris and the personal convenience of Jay Powell and the other members of the Fed board that we're seeing. They're not acting in the public interest right now. They're covering their ass because they don't want to admit they made a mistake.
But let me ask a question to Chris. Let me just go to you real quickly. The money comes out of the banks. Don't I just put it into money market funds? Isn't the cash still in the system?
Well, it goes into T-bills at 5%.
Right. So it's still there. It's not like I put it under my mattress.
Yeah, but it's inert.
No.
It's inert, right?
No, but
you have to. Let me take this, Chris. When you pull the deposits out of the banking sector, they've then got to sell assets, right?
Yep.
What are their
Yep.
assets?
Yep.
Well, their assets are loans to the house.
This bank accounting thing is very difficult.
Yeah, money's complicated.
It is.
Yeah, easy to spend, difficult to decipher. Yeah.
All right, Chris, what are some of the next steps you're looking for in the evolution of what we're seeing out there? Or what should we be on the lookout for?
I think the Fed needs to come forward and offer to finance all of these legacy assets that the banks have a problem with at par, at whatever the coupon rate is. So if I have a Ginnie Mae 2, the Fed should charge me 2% indefinitely until rates fall. That's how you take this off the table.
All
Very
right.
simple.
So, but Hugh, we've had some of the banks, regional banks, report, and most of them are saying, "Don't worry."
Of course. Well, they have to say that, right?
But
They
I mean,
can't say freak out.
But they're saying,
everyone panic.
Look at our balance sheet. Look at our stuff. We're
Doesn't matter.
okay. Hugh, I mean, do we not take them at their word? I guess, or is the problem too big for an individual bank per se?
Wait, do you have any bank deposits in the U.S., Hugh?
No, I don't. I'm in a very fortunate position where I owe the banks a lot of money. I'd recommend that. In fact, to everyone, I'd recommend you panic. I mean, this is a good time to panic.
Do you recommend gold? Do you like Bitcoin?
So gold has a logic, okay? But when we look at that kind of bell curve of distribution of where we are in distribution of returns, like gold presently is a little bit too far on the right axis in terms of like, it's kind of rich. It could be richer.
Yep. At 2054, we're almost at the all-time high.
Do you know what I like?
What?
I like the bell curve. I like when it's hitting the x-axis at 0 on the left-hand side, which is to say you're like 2-3 standard deviations below the price norm of the last 40 years.
Right.
Welcome to the world of the ultra-long treasury, the most despised security because we got the bogeyman of inflation, right? So the TLT, the ETF, has halved, right? 180 to 90, today it's 100. I think that's an easy moonshot back to 140, 150.
Wow. Wow.
They go long duration treasuries.
TLT. Chris, what do you think? I mean, where would you put your money right now?
Well, I think Hugh is right. It's hard to argue with the Treasury. I mean, my God, why wouldn't you be in
Everybody's at the
90-day
short
deal?
end of the curve, right? I mean, hence the price.
Yeah, but the hedge funds
long
are at
end
the
is
short
no
end.
deal.
It's a function of so it's like with duration. So if you've got a drug dealer, sorry, I meant to say ISDA contract with a prime broker, right? Then you get mountains of leverage, and you can own 2-year. But if you've got an NEV of $1 billion, you might have $100 billion in the 2-year, and you'll make money. When in the ordinary world, we own the TLT. You've got to own duration to get to soup up your returns for a retail investor. That's how that equation works.
All right, we're going to let Hugh go because you have some TV coming up. So we appreciate the time with Hugh. We're going to kick you out.
Now, I just want to quickly
Yes.
ask. I see at Hendry_Hugh for your Twitter.
Darling, I love you.
Yeah, okay. At Hendry_Hugh is where you find Hugh Hendry.